Leaders at multi-business firms add value only if their portfolio is worth more than the businesses would be individually. But leaders receive very little guidance as to how to approach key corporate strategy decisions, such as which businesses to enter and when, whether to divest, and how to apportion resources across an entire portfolio. A new book, co-authored by INSEAD Professor Phanish Puranam, sets out to address this. He joins me now on INSEAD Knowledge. Thank you for being here.
Thank you for having me.
So why did you write this book? What, in your opinion, is the problem with how teams normally approach these corporate strategy decisions?
I believe as a field we have become very sophisticated about business level strategy. So we understand a lot about how individual businesses compete, the forces of competition that act on them, the underlying resources and capabilities, and how to find new business opportunities. But the moment you look at any reasonably large-sized company, you notice that they're typically portfolios of multiple businesses. And where I believe as a field we haven't done as much to help practice is to think in a more rigorous way about managing these interactions between these businesses. The reason we think this is important is this problem of corporate strategy, which is managing this portfolio, is more than simply doing well in each individual line of business. In fact, one can imagine situations where one would consciously give up an advantage in one business to do better in the other. As long as the winners win more than the losers lose, the portfolio on average is going to do better.
Different HQs tend to take very different views on how to manage the subsidiaries within these multi-business organizations. Any thoughts on that?
People often tend to think about headquarters in these large multi-business firms as being strong or weak. And that's not very precise. In our view, a headquarters can be very strong and effective, but in a number of different ways. So one way in which we think about the different ways headquarters can have an influence is to think firstly in terms of, is the influence directive or is it evaluative? By directive, we mean headquarters decides what the right strategy is for each business, and then the business units implement. By evaluative, we mean that headquarters essentially delegates the strategic decision making to the businesses, but evaluates the financial returns. Neither by itself is weak or strong. Both are compatible with very effective corporate strategy decision making. The other dimension is whether the synergies in the portfolio, the gains from being jointly present in the portfolio, are they going to arise largely through linkage, which means actively pursuing opportunities for sharing knowledge or resources across the business, or are they going to be driven by standalone models, by which we mean, for the most part, the businesses operate independently, but they do draw on certain common resources like a shared brand or shared management expertise. So these two dimensions, whether it's directive or evaluative, or whether it's standalone or linkage, can give rise to a variety of different configurations in which headquarters can influence the portfolio. There's no one right answer.
How does one value an acquisition from a strategic perspective?
The big difference between valuing an acquisition from a strategy perspective as opposed to a pure finance perspective comes about from a couple of different factors. The first is an acquisition is an alternative to other forms of growth. So when you're doing a valuation for an acquisition, you need, at least at the back of your mind, to have some sense of what value could have been created if instead of doing an acquisition, one had chosen to do an alliance or an organic growth project. So in some sense, the M&A valuation must be preceded by at least an approximate valuation of the other growth paths that were not considered. The second big difference lies in the fact that synergies play a very important role in understanding valuation in an M&A. And these synergies can only be estimated, I believe, through a deep understanding of the operational links between businesses. Relying on things like multiples, which I know bankers often do, is a very crude and unreliable indicator of synergies. You need a bottom-up, NPV-based approach of thinking about synergies to really value the company. So that's the second big difference. And third, ultimately, the difference between a corporate strategist and a consultant who advises and then finishes the project and leaves is they have to deal with the actual integration of the businesses. So unless one takes into account the challenges of post-merger integration, and not just in the sense of knowing it's going to be tough, but thinking of how do I factor that in at the time I make the valuation decisions. This is something that strategists need to do, but I simply don't see them doing enough of.
And a lot of the points you make in your book would perhaps raise some questions among those who practice conventional corporate finance. What is the role of corporate finance in your view?
The distinction I would make between my way of thinking about corporate strategy and corporate finance, and perhaps the way a finance professor would, I tend to see the valuation and the finance as a language. I don't believe this guarantees us the right valuation number, because often the assets we are talking about are not like stock. Stock is traded every day in large volumes, so we have enough data to come up with very good ways of estimating their value. When you're buying a company, it's an idiosyncratic asset which will not be traded more than once or twice in its entire life. So the purpose of the numbers is not to come up with the right answer. The purpose of the numbers is to create a common language for rational discourse on a number that both sides like.
It's an aid in the negotiation process.
Absolutely. You should think about it as a framework for having a rational negotiation process and for, of course, thinking about alternatives, not as a task of trying to figure out what is the one true right answer of this valuation.
Thank you very much.
My pleasure. Thank you.